And joining us now to talk the market trade, we say hello to our good friend Mike Zuzolo with Global Commodity Analytics joining Market Talk here with us. And Mike, great to catch up with you again this week. How are you, sir?
Doing great, Jesse. Thanks for having me back.
Appreciate the time, Mike. Let's jump right in. Looking at the markets here this week, we've seen plenty of pressure of the grains and oil seeds. I think a lot of factors kind of combining. You talk the weak economic news out of China, the weather, some of that rain that we saw, cooler temperatures, crude oil kind of falling back. There's just been a lot of things that's felt like in this grain market overall that's kind of been a bearish weight, a bearish influence here throughout much of this week, Mike.
Yeah, everything you've mentioned almost has a hallmark of that demand fear returning back into the marketplace. And that demand fear is led by the fund liquidation demand investment fear. I think, Jesse, that's the best way to, I think, wrap a ribbon around these fundamentals, excluding a couple key fundamentals in the wheat. But I think it's really important for producers to realize in grains as the ranchers and the cattle, excuse me, and the pig producers see continued multi-month highs on strong demand, the grains continue to suffer. Even the wheat, which received probably the best report from USDA in terms of both US and global ending stocks. And I think this really translates back into the charts. It translates back into the whole inflation bet on the long side that started in late 2020 and really ramped up in 2021. We're at a critical time phase that we are once again in a period in the Northern Hemisphere where we see crops burning up, producers sending me pictures of corn that are tipped back almost 40% at this point in some areas, indent in some areas. So no rain is going to help any corn at all. In fact, rain is probably going to hurt the corn and the stalk quality at this point. And yet the market keeps sinking. And so we've got this decoupling and this dysfunctional market again, where we're back on the outside, as you say, macro side of the markets and the weaker demand side of the markets for the grains, instead of putting both the supply and the demand together. And I think this is a critical piece of the puzzle as we get close to September, with the idea that we may be ramping up, if the wheat can't hold up here, into making a pre-harvest low in the corn and beans, especially if we can't hold that harvest low in the wheat complex.
Let's talk a little bit more about the wheat side, Mike. I know a couple charts you sent me here as well. I mean, we saw wheat a pretty aggressive sell off on Wednesday, and that kind of continued through the overnight into Thursday. Pulling up the monthly SRW chart, walk us through what you're seeing here. This wheat market, you talk about it holding up, and I'm a little curious to your thoughts here because I'm maybe a little concerned with some of the price action I've been seeing lately.
Yeah, to me, Jesse, this is the backbone of the grain rally. It always has been, and it continues to be. And the blue support line, as you see, is drawn off the lows from the second and third quarter of 2020. We tested that low again in the middle of 2021. Here we are now again in the middle of 2022, testing these lows again in that trend line. And now we're going through them. And as of Thursday morning's Globex trade, the market has been able to take out the August low now. So we're now below the July low. We're now below in a new August low. And now all we have for support, because the trend line is gone, is the 2022 low, which was made back in January of around 735 and a half. And I think this on a weekly basis is absolutely critical to hold, because if we don't hold that, that chart looks like a topping pattern. And also that chart looks as though we're going back into the weeds as far as a sluggish market. And again, the USDA report came in and took US wheat stocks to use ratios down to a little over 31%, took world wheat stocks to use ratios down to just under 34%. We're at the lowest stocks to use ratios in both US and world wheat supplies now since going back to after 2012, the 2013, 2014 marketing years. And so we don't have justification fundamentally, supply and demand for this. What we have justification for this is that Europe is coming on board hard, and in terms of its price is correcting substantially. That's partially due to Ukraine, but it's also a big factor, goes back to the funds and how they trade the currencies. And the dollar has continued to make multi-month highs. And I think this is a key factor that we continue to kind of wash over in the trade, if you will.
Well, Mike, I'll pull up another chart on the video feed as well, and this is a comparison you have between EU wheat and U.S. Chicago SRW wheat futures. So, talk about this a little bit. And I know on the EU side, we've been seeing a lot of production issues. Of course, there that's something that we have to keep in mind in the markets.
Yeah, the corn in the EU market is falling as well towards the mercantile exchange price, but not nearly as dramatically. And this makes sense fundamentally, as you say, because the production problems have not been baked into the supply demand yet. And I think the USDA did start to do that by showing a lot of problems in corn production in the northern hemisphere, especially in Europe. But again, this is why the wheat market is such a key factor. And it goes back to the Paris wheat has been the leader to the upside along earlier on with the spring wheat. We lost the spring wheat support. Then we had the Paris wheat support continuing to give us support because of the currencies and because of the Ukrainian supplies being held up in the Baltic. And so the EU wheat, as you and I have talked over the months, has been the clear leader to the upside. So what does this mean to the U.S. farmer, though? And I think it goes back to the feeding, the livestock rations. We've got a soft red wheat minus corn price. That spread is down below $1.40. It typically, Jesse, when you get to around 80 cents wheat premium to the corn in the soft red wheat belt complex, that tends to bring in a lot more feed wheat feeding. And we have seen now in both Russia and Ukraine news reports of harvest that the quality is not nearly as good. So it is a concern, and Ukraine does have some responsibility in play for why this EU market is falling. But I got to throw some responsibility back on the United States and the U.S. aid newswire release right around 8 o'clock on Wednesday morning saying that the U.S. was going to buy 150,000 tons of Ukrainian wheat to give to poor countries. That just added another competitor to the United States. And I scratched my head immediately and said, why aren't we sending our wheat to the poor countries? And I think the trade's thinking the exact same thing. So bottled up in all this logical, rational, fund-driven, investment-driven liquidation are these spears that come at us out of nowhere that just emphasizes to the funds it's right to liquidate. And I think this is a necessary thing to think about and talk about because it is really impacting us.
Another spear I'll throw in there as well. The Iraqi cancellation of U.S. Wheat tender on Wednesday wasn't widely reported, but that was another reason that I think that kind of added to the sell-off as well there, Mike. And it goes to prove your point. All these little things just getting thrown in this wheat market that just kind of just slows it down, in my opinion, Mike.
Unfortunately, since the 70s and 90s, when we ruled the roost in the Middle East and North Africa for wheat business, we have to have the dollar on our side. And I think it really does boil down to that, Jesse, when it comes to the funds and the investment flows. And I know I'm oversimplifying it, but I think, we have to build this in to the marketing plan. So the bottom line for me is we lost beans because the USDA report yield increase. We're relying on corn and wheat to support the beans. Now we're losing wheat, and this opens up a pre-harvest downside move in the whole grain complex that we have to be aware of. And I think those puts are very good potential risk management tools to look at, not cash sales because of what's happening in the fields, but what we're looking at is this futures-led decline that I think we might want to tap into.
Well, you mentioned the futures decline. You mentioned cash, though. I just want to maybe grab your thoughts real quick there. Basis has held up fairly strong, but starting to kind of fade here as we get into that typical time frame where we get old crop and new crop basis start to kind of come together typically in quarter beans, or at least we get out old crop and go completely to new crop. So as you look across the countryside, I know it's going to be a regional thing, but what are your thoughts just on the state of kind of the cash basis, cash market for corn and beans right now?
Well, I think your basis is going to do all the heavy lifting, and I think that's where the basis is probably going to start to be propped up. But I think one of the things that clients have asked me is, well, when do you feel better about the funds? When do you feel better about the upside potential in the grains if we have this break to the downside? And it's all based upon the cash. It's all based upon the export market, and it's based upon the funds watching that very closely. So watch the Thursday export sales. watch the Monday export inspections reports. If they start to come around and the U.S. gets more business, then I think you've got a decent chance that the trend is going to change in your favor as a producer. But we noticed after the July went off the board for corn and after the August went off the board for beans, a week ago, you and I were talking about a $2 spread between August and September beans. Now we've got about a 60-cent spread between September and November beans. The USDA report did not take carryover from last year down in soybeans. That just added to the weakness in this overall market.
Mike, I want to shift over and talk livestock. I'll pull up another chart on the video feed. The kind of livestock prices chart, looking at cash cattle and hogs from USDA, and I look at both of these markets right now, Mike. I'm just kind of curious your thoughts with where things stand now that we look at cattle trying to get some support in cash country, but futures holding a range. Hogs, now that August contracts off the board, we're on to October now. I mean, there's a lot of things going on in this protein sector that I think we need to keep an eye on. What are your thoughts with what we're seeing right now?
Well, the nice thing about this chart that I did was it was both the combination of the WASDE report and also the last livestock, dairy, and poultry report going and taking some of those older years. But the nice thing about this is what you notice the jump from July 2022 prices to August and how big of a jump we had, especially when it came to the hogs. And then from July 2023 to August 2023 projections, we saw another big increase in the cattle. So the USDA is keeping track with this demand-led market. They've written a lot about the consumption, the retail sales that we're getting from stores like Walmart and Kroger and Target. They are saying, yeah, consumers are pulling back on electronic goods, home goods, but they're really still sticking with the food side of the equation very strongly, and they're taking the price increases very well. This all boils down to why essentially the funds are buying the livestock and the meats and selling the grains right now. And so we're in kind of the catbird seat in the livestock sector. I think in the short term here, Jesse, with Friday's cattle on feed report, we need to see a strong month of marketings again to justify what I just said about some of this other anecdotal evidence. But now that we filled some gaps in the fat cattle chart, now that the funds are as long as they were back in, I think, May of this year in cattle and March, in hogs, as far as non-commercial length in the commitment of traders report, we are in essence USDA funds and the cash market keeping up with the strength in the hogs and cattle. And so it means futures to me has a premium in them. We got to be ready to hedge very, very soon. And I think that very, very soon could be as early as October, as soon as we get done with that last summer holiday of grilling on Labor Day. So that's kind of where I'm tracking at this point, especially with the fund movement and USDA not behind the curve when it comes to prices.
Well, Mike, I want to ask you as well, and this could tie into not only the protein sector, but grains. You follow China a lot. We saw the weak economic data out of China earlier in the week, and then, of course, the geopolitical tensions over Taiwan with the U.S. and China. So, as you've kind of been watching this week, the China issues on many fronts, how is that impacting the market, and what are some things we really need to keep our eye on here moving forward, do you think?
Yeah, that's a really great question because it all wraps back up into the demand side of the equation. And a big reason why the funds are not playing ball on the long side of the grains now is because their expectations are not as high as they were back last year when the phase one trade deal was put into effect and China did buy a lot of extra corn, beans, and wheat, and they're still buying the pork and beef, Jesse. So my mindset is that wraps back up into the U.S. export demand coming back, and that wraps up into China coming back. And I think with their economic data, and one thing that is coming on now is a severe drought in a major area of their industrial and pork complex. Sichuan province is their number one province for pork production. And I'm very nervous that the soybean demand side is going to remain subdued because they're going to lose livestock in terms of their herd over there in that province because of a record drought and record setting heat. They could continue to buy pork, but they'll probably continue to really suffer from crushing meal, and their meal margins, crushing margins are still negative in some key provinces as well. So that all wraps up into China's the king of commodity buying. When they don't, when they get when they start sneezing and they get a head cold, the rest of the market gets a flu. And I think that's where we're at right now and having to contend with that.
Well, Mike, great stuff as always. Before we run out of time, any final thoughts you have for us on the show today?
I'll just reemphasize what we've looked at all year long, and that's the dollar trend and the price action in the dollar against the wheat. And I think that's still the number one feature to watch. I think the Federal Reserve now is going to back away from raising rates. I'd be surprised if they raised rates the rest of the year, given some of this economic data. So I'm hoping that that actually puts a top on the dollar again by the time we get to like around October. So my analysis is boiling down to grain low equals dollar high, and that's kind of where I'm at. But otherwise, go to the website and get a free trial.
Globalcomresearch.com. That is com with two M's. Globalcomresearch.com is where you can get that free trial. And of course, we always we always appreciate the time. Excuse me there, Mike. Thanks for joining us here today on Market Talk, and have yourself a great rest of the week. We'll talk to you next week.
Thank you, Jesse, and thanks for having me, buddy.